You know Shaletta makes you laugh, but did you know Shaletta Brundage can also make you think and boost your business? Media personality, activist, and comedian Shaletta Brundage founded Shaletta Makes Me Laugh to celebrate and share the best of Black culture. It's a podcasting platform. You can download 10 weekly podcasts hosted by African-American subject experts at ShalettaMakesMeLaugh.com or wherever you find your favorite podcasts. ShalettaMakesMeLaugh.com is also a production house, creating broadcast-quality commercial content. And Shaletta and her team of storytellers create powerful promotional campaigns to get businesses the brand awareness they're looking for. Some of Minnesota's top businesses trust Shaletta, and you can too. Get out the word about your events and products and get in front of communities of color with ShalettaMakesMeLaugh.com. She's got the power to help your business.
Hey everyone, and welcome back to another episode of the Financially Fit Podcast. I am your host, Creighton. As always, I am really excited to be here with you all, and this episode is super special because this is the last episode of 2025. What a year it's been. It's been fun engaging with you all, walking us through the fundamentals of growing a business, starting a business. We made the shift about, I think, Q1 or Q2 from talking about personal finance, which had been the focus of our podcast for the past 2 years, into talking about how do we help business owners and executives and everything in between, right? And I think it's been a fun ride, and I'm really excited to really reflect on what everything that we've been through this year, and really how this affected a lot of business owners and entrepreneurs throughout this year. So, this episode at the end of the day is not a recap episode, it's a clarity episode. And I think, that's the narrative that I want to roll with this year is like this was the year that the narrative changed for a lot of entrepreneurs. And we'll talk about, why that changed and what the change was. At the end of the day, 2025 wasn't about acceleration. In the past, we've seen a lot of entrepreneurs flying 1,000 miles an hour, trying to grow revenue at any cause. And I think, this year, what we saw was founders really take a step back, especially as they think about how cautious investors were this year with capital, and really also like thinking about like long term, like how much equity do they want to continue to have in their own company, and control over their own company. I think this was a year that wasn't about acceleration, but it was about recalibration. So let's talk a little bit about why this matters. Founders, executives, investors, I think they all felt the shift. Even if no one really said it out loud, I think investors were pulling back capital and being very cautious about the things that they're invested in, taking very, not that they weren't taking strategic bets in the past, but I think really honing in on like, is this a business that's scalable? Show me how you're going to scale this. Show me why this founding team is the team to be able to do this and take this venture to the next level, and really be honest with me on what your forecast looks like, right? I think oftentimes, the days of founders coming in and saying, "Hey, yep, I'm gonna get X amount of users by X date, and I'm gonna have 10 million in revenue in a year and a half." Like investors really honed in on like what is realistic, and I think, while it wasn't necessarily a hard no to a lot of founders if they didn't or weren't able to portray that message clearly. I think it was a go back and do more homework, right? And I think that had a lot of founders having to pivot and be more creative around like, how do I grow this thing, expecting that I might not get investment. I've been through, hundreds of VC calls, and I'm not getting the traction that I need to get the capital I need to be able to grow this thing. So now I'm gonna have to do it organically. And I think that's good. I think it's good that founders really had to get gritty, that they had to put more skin in the game, because I think when you have skin in the game, I think that it holds you to the fire for the longevity of the business. I think it also helps you understand the value that you bring to the business and the value that the business should bring back to you should you continue to grow this thing and it gets to a point where you can exit. So I think, founders really looked at it and said, hey, like, I'm gonna bet on myself, and I'm gonna put money into this engine, and we're gonna make it go. And with that being said, I think as the founders were, some of the founders were successful in doing so, they said, hey, I don't even need VC money. Like, I can do this myself. I think executives on the other side of this, not talking about founders, but executives that are running businesses, this was a trying year as well. Just especially with all the government stuff as well, and maybe even some of the executives that were dependent on government funding. I think that they had to get creative too. We saw a lot of mass layoffs across a lot of organizations, a lot of executives having to make some very tough decisions. Uh, and I'm never a believer in layoffs. I think there's always a better way to do it. I think at the end of the day, those making the money at the top, I do believe that that should trickle down to the ones that are working hard and driving the growth of the business at the bottom, I should say. Not that the executives aren't doing the hard work, right? Like, they're setting the strategy, they're the ones really guiding and driving the ship, right? But at the end of the day, the people with the boots on the ground are the ones that likely are being laid off. And I've never been a fond believer in that system. I think that there's a different way to be able to do that. So how did the narrative shift this year? So I think the early 2025 mindset was cautious capital. We talked a little bit about this. Investors are very cautious. Doesn't mean that they weren't deploying capital. I think that they were allocating capital differently. If your business didn't have an um, AI piece to it, it was a lot harder to get capital. I think that everyone is in this AI race right now of who can get to the top the quickest. And I think a lot of people are making some bets on AI from an investor standpoint. And if your company didn't necessarily have an AI component to it, I think it made capital very difficult for you. I think, obviously there was noisy policy environment. So, we saw the government shutdown. We saw how that delayed grant funding. Now, I think when you think about grant funding, a lot of people think about how that affects nonprofits. Certainly, it affected the nonprofit space. But also, there are a lot of other for-profit companies that depend on SBIR grants, and these are grants that for medical device companies that are trying to expand technology to solve some medical problem, right? A lot of those were interrupted, right? And they're dependent on grant funding, specifically because a lot of them are pre-revenue and are pre-revenue for a long time, especially if they're trying to get through clinicals and before they actually get to market and are able to sell. So, that has a great impact on our health system, and it's a trickle effect. So, there's definitely a lot of noise in policy. There's noise with tariffs, and that affected manufacturing in various business across the spectrum as well. So, I even have seen that some businesses that were doing really well, they had to go out of business because the tariffs were so great in increasing their capex, their OpEx and capex, that you know it just made it very difficult for them to be able to survive. Especially if profits not coming in the way that it should. And then think about if specifically if there are companies that are you know, buying from those manufacturing companies, but they're also dependent on are being, harmed by the tariffs as well. Like, it's a double effect on that company. So, you know, we also saw conflicting market signals. The market's been like this all year. We saw early in 2025 the market kind of, I wouldn't say crash, but it took a dip, right? And then we saw Liberation Day and some of that, where then the market starts to take off in that April timeframe and really start to scale, and then it dropped again later off in the summer into the fall, and now it's starting to make a little bit of a move again. So, really just it's been a whirlwind of a year when it comes to markets, when it comes to growing a company, when it comes to capital markets. It's been a difficult year. So, what quietly changed was speed. Speed was no longer the northern star. Efficiency was. So, how can we be efficient with our capital? How can we be efficient with our resources? And how can we build efficient revenue? Right. That's been the key. And then, valuation. A lot of companies that, obviously have raised capital in the past. Now we're seeing more safes than ever. So, uh, you know, the safes, typically we've seen that a lot of people um, tend to move towards a convertible note. That's been traditional, right? But we've seen a very big uptick on safes, and actually safes are starting to be more prevalent than convertible notes. So what a safe is, it's a simple agreement for future equity. So basically what that says is that um, I will give you a discount at valuation caps, call it 2 million, and I'll give you a 20% discount, and you give me X amount of dollars to fund my company, right? And then that money will convert into capital when I raise the next round, or if there's a liquidity event or something of that sort, right? Where on the alternative, a convertible note is really, I would say, just a long-term debt that can convert into equity. Most times it can be also just paid back with interest, depending on what the clauses are in that convertible note from a legal standpoint. And we're seeing a lot of people move away from those and into the safe note because it kind of kicks the can down the road on like defining an evaluation. So back to what's quietly changed is like less focus on valuation and more focus on durability. And then lastly, like lots of talk around like right? Raising capital. I think the notion went from away from can we raise to should we raise? And this goes back to what I talked about earlier in the early parts of the segment around capital was tough to acquire for a lot of companies this year, especially if you didn't have an AI component to your company. So it put it backed founders into a corner where they had to make a decision to say like, hey, I'm just going to bootstrap this business and see if I can grow this organically. And I know that that might be slower because I'm not getting an infusion of $1 million of capital. But that brought up the questions of instead of can we raise, should we raise, right? Because now founders are saying, well, I have grown the value of this company. I think I can continue to do this and box out my competitors still and be just fine. Well, then why would I raise capital and give up a bunch of equity when I've worked hard with my own money to build this? I'd rather see this through and then get to a point where if I am in dire need of capital, where if I don't get this, I can't reach the next 2 or 3 milestones to really grow the business, then we'll cross that path then. But if not, then I'm going to grow this thing slow and organically, and I'll hopefully I get to an exit, and then I still keep a lot of the equity to myself, and I have a great day when I get to that exit. So I think that's the question that a lot of founders start to ask themselves as they were kind of backed against the wall around like, can I actually raise capital? And in this market, it's been very difficult this year. So, um, I think, when we think about recalibration, like it feels like a slowdown, but in all reality, it's actually maturity. I think when you take time to recalibrate and you're constantly recalibrating, it's a way for you to show that you are maturing and that you're heading down the right path. So I'll just do this one thing for you. Imagine that so most of us probably have cars, right? Every so often we have to take our car in to get an oil change. We have to get our um, tires rotated. We have to put air in our tires. We might have to get our uh, coolant change. All of these maintenance things to be able to keep our car running, right? To be able to get from point A to point B. The same is true in a business, and what I call that is recalibration. Recalibrating and really diving into the fact that I have to rethink, redo, and constantly be thinking about how do I make my vehicle, which is my business, run more efficiently, and that's recalibration. So, I think the other thing we should talk about is um, what technology actually taught us this year. So, AI evolved way beyond the hype. It shifted how leaders use tech. It became less experimental, and it helped really with more decision support. So more focus on forecasting and signal detection. So really using AI to drive and help with decision making, not using AI to create all of the narrative and us just being highly dependent on AI, but using it as another resource, another tool in our toolkit to be able to help drive decision making. And that's the way that I use AI every single day. Is I use it as a way to help me be more efficient, to help me be able to make better decisions, and to help me to be able to provide better content as far as the way that I deliver my content and then the way that I deliver my content. It doesn't write my content for me. It doesn't do forecasting for me. It doesn't do accounting for me for the clients that I work with. What it does is it helps me hone in on my thought process on how I'm thinking about designing things when it comes to my clients, or how I want to maybe portray a message to a client more efficiently after I've already written it. So, some of the winning behaviors is using tech to reduce uncertainty. AI allows you to do that if you use it right. It does help you reduce uncertainty. It should not help you. It should not amplify noise. So if it's amplifying noise, that means that you have too much data points, you're too highly reliant on AI. It should be a support system for what you're already doing. So, tools at the end of the day, tools are not replacing leadership. Leadership is uh is inevitable and it is imminent. We have to be able to have good leadership and be able to possess the leadership skills to drive a company forward. Now, technology is just a tool that helps amplify that leadership. It should help expose clarity. And for those that aren't utilizing their AI, I'm guaranteeing that your teams have less clarity because what you can do in AI more efficiently uh, with your time is really how you get to that clarity. So, some of the finance lessons that we learned in 2025, honestly, finance re-entered the strategy room. I think that for a long time, finance um, has started to be pushed to the wayside, a kind of an afterthought, especially in the entrepreneurial space. We find that a lot of founders and entrepreneurs are very visionary. They typically don't want to spend money on finance or hiring finance. Honestly, CFOs usually are kind of the last ones hired. Usually, they just have a bookkeeper or someone that's just keeping the books and making sure that um, that side of the house is done and accurate. And quite frankly, most founders don't even know if they're accurate because they tend to not have accounting or finance savviness to them. And I think that's shifted. I think with AI, that has shifted completely. I think AI has allowed founders to ask the right questions around what things should they be focusing on the finance side, which then allowed them to be able to find the right hire, and then be able to ask the right hires, whether it's a consultant, a bookkeeper, or CFO, or controller, whoever it may be that's in their back office, be able to ask the right questions, and have the CFOs or that accounting and finance professional be able to provide them with the storytelling that the data is telling them. So, there's a few focus areas that I talked about throughout the year that mattered. Burn multiple versus vanity growth, really understanding that burn rate and the burn multiple. So really at the end of the day, how fast are you burning cash versus how fast are you growing revenue? And I think that's the efficiency piece, versus like the vanity growth of like, we're going to grow at all means. And like we're spending, maybe we have a high CAC, maybe our lifetime value or LTV is very low. Like those things started to matter more. versus just growing revenue at all costs. I think cash flow timing became very important, and that goes hand in hand with when you're not getting the VC capital that you need as an entrepreneur and you're putting your own money in, you have to be conscious of your cash flow. And it's not meant saying that you shouldn't be conscious of your cash flow when you are utilizing some other people's money or VC money, because we should be good stewards of the money at all times. But what it is saying is that because it's your own money, you have more skin in the game because you are directly taking that loss, right? And I think that also when there's not infinite amount of money, you are worried about whether you're going to run out of money. So there's definitely a lot more focus on cash flow timing. So making sure that we're turning revenue as quickly as possible and making sure that we're taking as long on those terms, those net terms that we have to pay our accounts payable. Um, a lot of founders move to scenario based planning. So, scenario based forecasting, thinking about the three that we talked about throughout 2025, worst case, base case, best case, right? So, best case being your super optimistic approach to your financials and your business strategy. Worst case being your super pessimistic approach to the business, meaning more so your doomsday. And then the base case is the one that we typically operate off of. This is like what we actually think is going to happen in the business versus, in the past, more static budgets. So static budgets being like, hey, we set a budget in November. We never revisit that budget again, right? That's the budget for the year. We're focused on that. We're looking at the variances on a monthly basis, and we're not making adjustments. Um, we're not making proactive adjustments based on what's actually happening in the business. So, some key lessons are strong companies didn't eliminate risks. They modeled it with honesty. So, you know, I talk a lot on this podcast about risk assessment. Risk is so important. And it's not one of those things that where you're being pessimistic, but it's about being prepared, right? It's the same reason why we have health coverage, right? I'm not necessarily worried about tearing my ACL. Maybe I was when I played football, right? Or tearing my Achilles, or maybe coming down with heart disease or any of those things, right? I'm not necessarily worried about those things. However, I want to make sure that I'm protected at all times in case I do. The same has to happen with your business. If you are not looking at the risk of your business, meaning your competitors, what are your competitors doing? How are people responding to the pricing of my business? How diversified are my revenue streams? How how much revenue concentration do I have? Does majority of my revenue come from one customer? If your majority of your revenue comes from one customer, then you have innately a lot of risk, because if that one customer leaves, well, essentially, let's say if it's 50%, well, you just lost 50% of your revenue. That could be make or break for a lot of businesses, right? Depending on how long your sales cycle is and how long it will take you to replace that 50%. So like these are all things that we should be modeling out from a risk standpoint to be able to understand, like, what are the things that we need to do to make sure that if these risks do surface, here's action plan A, here's action plan B, and here's action plan C. Um, from an investor standpoint, discipline became credibility. I think that investors were looking for founders that and entrepreneurs that are very disciplined, because that was their credibility. I think a lot of investors got burnt in 2020 and 2021. A lot of the companies they invested in, they took a chance on, you know, um, a lot of them are not alive today. And I think that there were a lot of risk taking, and money was flowing out of the faucet during that time. And I think um, a lot of investors are trying to recoup that right now. And some of that, and the way that's showing up, is they're looking for founders that are disciplined. They're looking for founders that have clarity. And while confidence is important, and confidence was likely in 2020, 2021, what was getting a lot of companies VC money, I think VCs have moved towards wanting to see what that clarity is now. So, I think, my personal reflection as we close here, as a founder, as a CFO, as an advisor who works with a lot of startups and companies, the core realization is momentum feels good, clarity is what keeps companies alive. So I think, as we are looking at, if 2025 was about clarity and discipline, 2026 is going to be about execution. um, VCs, investors, they're going to want to see that, hey, did you actually execute on those things from 2025 that you talked about? You had a lot of clarity, you had a lot of discipline around your business and some of the ways that you wanted to approach your business in 2025. Now, show me the numbers on what you actually did in 2025. Was the execution there? And I think that will be the telling factor on whether or not some of those investors come back and follow along in the next raise, or whether those entrepreneurs are able to go out and raise capital elsewhere, maybe securing the next round, right? So it's going to be interesting to see what happens in 2026. I am so elated to have been able to spend time with you all here in 2025. I really appreciate you guys continuing to rock with me. It's been a joy. I think, when I first started on this podcast, I've never been like a person that really likes to be out in the forefront speaking in front of a camera. That's never really been my approach. And I think, over the past 3 years of doing this, I've really grown in that area. You all have helped me feel more comfortable sharing what's in my brain through my experiences, through the experiences I have working with other founders, what I'm hearing in the marketplace, from investors, from VCs. And, I'm just so appreciative for you all giving me this platform. So, with that being said, as I always say, it's not about how much money you make, the power is in how much money you keep. Thank you so much. Happy New Year's, everyone. See you all in 2026.
Hey, it's your girl Shaletta. Are you over there running low on your insulin supply and worried how you're going to pay for it? Minnesota's Insulin Safety Net programs got you covered. If you have less than a 7-day supply of insulin, you can get a 30-day refill for just $35 at any Minnesota pharmacy. Go to mninsulin.org today, print out the application, complete the form, and just take it in to your pharmacy. Go to mninsulin.org.